Welcome to another AriasWave market update. So in this video, we're going to talk about the main markets, not crypto, just the regular markets. Crypto video is coming next, so stay tuned for that one. So just continuing on from my previous market update, it was titled, It's Never All About One Chart. So we start off here with the 10-year bond yield, but this time I have it labeled in the way that I have been saying that this thing will play out. Except now it's just getting to the point where it's time to really start, assessing basically the severity of where this is going. So we have it labeled as of 2020 as a wave one, A, B, C, and then this move that's happened since that low has been, in my opinion, a D wave, which is considered the breakout wave. Okay, and I did say we'd come back to retest that channel, which we did. Um, and that E wave, you could see quite clearly it's a 5 wave move. It's a weak one too, and it looks like a type 2 weak 5 wave move as well, because it's looking like it's impulsive but so weak that the waves 2 and 4 overlap. So now it's just gotten to the point where, okay, I'm gonna put a line in the sand here, and that's at the top of the D wave. So the top of the D wave, there a break of that, which we're getting very close to now, would confirm that we are basically getting ready to move higher. Okay, and move higher, I believe we will, right up into the point where something something breaks, which you'll see on the next charts about what I'm talking about. To some extent, this is the main driver of the Fed tightening process, and the interest rates rising. They are in line with the larger pattern. We're looking for a large 5 wave move up, and we are just in the beginning stages of that. This move up would be an E wave, as I've mentioned in previous videos, uh, of a zigzag once we get to the end of that, which is going to be pretty high, by the way. I do believe we are going to see rates being cut again, and the cycle will begin again. But for now, we need to see 5 waves up to 15, 20%. Not sure, 20% is a bit high, but look, this is just what the analysis is telling me. But as you can see, an expanded wave two of this magnitude would suggest that this is nothing to play with. In previous, well, if you go back through history, obviously not on this chart, I think it goes back to 81. Um, you can see quite clearly that rates can go sky high in a very short period of time. So it's not like that cannot happen. It is very possible, and it has happened before. So as I keep mentioning, the crux of all the analysis begins with this chart. And then now I'm going to show you a list of markets which also indicate that we are in the beginning stages of a move down, which is also a wave E as well. So how would I label it, and do we see reoccurring patterns happening across the board? And in my opinion, it's a yes, but the way that the labels go would have to be explained in order for you to sort of understand um, why I believe this is to be the case. So at the top, at the high here, you can see a small zigzag pattern, right? Now, this zigzag pattern does not have a place here unless it's part of a larger move, unless it's part of a larger correction, right? In this case, it looks like a 5 wave move. Okay, so that would be the beginning of potentially a larger 5 wave move down, depending on the correction after the 5 wave move. So here you have a 1, a 2, a 3, a 4, and a 5. Okay, that's how this particular market reads it. And I'll just point this out now because I'm going to bring it up in a later chart of the NASDAQ, how wave 4 ended a bit higher on this chart. Just doesn't really mean much. It's just in terms of analysis if you're tracking the waves. So week 5 wave move down, type 1, followed by an A, B, C. Now, I did originally think that it could have been an A, B, C, D, E pattern in here, but looking through it now, it looks like, yeah, it's something else. So I believe that was just a C wave up. So I did call that top in the last market, and we did see this move down. Now, I don't think that top is wrong, at least not for now. I, there is a bit of, there's more to it. Okay, so if this is a C wave, in my opinion, we're looking for a D wave. So now this is what I believe the D wave will look like. It'll probably head right into that midterm elections, and then it'll bounce. Okay, and that bounce will be a suckers rally, which will terminate and then reverse to the downside. That's just what I'm seeing. It's what I think could be the scenario here. So at this point in time, I don't think there's any reason basically to doubt that. So um, the way that I see this playing out now at this point is from this point, I believe we will it'll just become very choppy up until we finish this B wave of this D wave. Okay, that's just what I think, and it's kind of in line with a lot of other analysis like XLM, except moves in cryptos, they can be a little bit more volatile, even though in this particular case, we've seen more gains on the Dow Jones and other markets compared to cryptos in recent times. But I believe that's simply because cryptos are lagging slightly behind what the stock market is doing. That's my belief. It just seems that way just because of the labeling. Okay, so eventually, I do believe that we'll get to a point where it'll all line up and some pretty big moves will happen in tandem. So that's the Dow Jones. If you want a clearer picture of this, the US 30 chart is basically the same. Um, Same deal, 1, 2, 3, 4, 5. We came back up, we hit the 0.618, we reversed lower, but I think that we're just going to chop around because we're in a D wave. And in my experience, anything relating to elections tend to be around E waves. They basically fool people into thinking the trend is changing, and then it reverses. It's happened to me. It happened in 2016 as well with the Trump election. That reversed to the upside, except this time I think it's in reverse, and it will bounce, and then will reverse to the downside. So that's just what I'm seeing according to this pattern here. So S&P, same deal. I didn't quite label that one. That's fine. We'll go to the NASDAQ. So very similarly, the NASDAQ here we have the zigzag 1, 2, then we have a 3. We had a sharp zigzag there, and then 4 was expanded. I believe it expanded to this area, and then we had a third. So the fifth wave zigzag down, right? So that's how I see that. And then we had an A, B, C currently also in D. Now the A wave in this one looks a bit different. I believe that the B wave within the A wave expanded. That's why the labeling is a little bit different. But it's also interesting how the wave 4 looked like it ended down here, and minimum expectation for um, a bounce is to at least come back to around that previous wave 4 area, which it's done already. Um, you know, Look, at this point in time, the bounce that happens around November, there's no telling how that will look, but it probably will be a very volatile period of time where the market sort of bounces around. And I believe it'll be very predictable. If this plays out the way that I think it is, obviously we're going to track it. When we get to that point there where it's looking like it's going to go down because D waves can fool people into thinking that the trend will continue lower, it'll bounce, and then reverse. So across all these charts, this seems to be the main uh, theme. It looks about right. Going back to oil now. I remember Martin wanted to know a bit about the oil chart there. So I mean, normally I'd use log scale on the other markets I was looking at, but we're in a small time period, so it's really not that important at small degree. It's more important at larger degrees. But in any case, this pattern here, as I mentioned in my previous market update, I did believe it was a wave D, and then we'd see a bounce for wave E in 5 waves. And I believe we did see that, and then we reversed back down. So line in the sand here, it appears to be right at that little mini peak there. That looks like it could be the end of wave two for basically the move that's coming lower, 5 wave move down. Um, we've had a 1, A, B, C, D, E, and basically it looks to be bearish as anything right now. For me, that's a good confirmation, a break of the low, that this will just continue to push lower. When it comes to like currencies like the US dollar, it continues to strengthen as per the view, which is the preferred view that this is going to go much higher, and it has to go to at least minimum expectation is 165 on the index, right? And that's simply because of the patterns have to the end of the end of the move has to go above all previous impulsive and corrective moves. So as you can see, my count here is A, B, C, D, E. We contracted into this area, and then I've been saying this for the longest time. We are going to push, and we're going to push high right up until we hit that top there. At least that top, even if it just touches above it, that's all we need to see. And then we'd be paying attention to everything else that's probably going to be happening around that time on the other charts. That's why I say it's never all about one chart. But this pattern here, even though we don't have historic data and it's incomplete and all that sort of jazz, it's pretty clear to me that this is the kind of pattern that we're looking at, regardless of anything. And the way that I see it, it simply comes back to some truths that we know, according to AriasWave, is that there are only two patterns that occur in the markets. There's zigzags and 5 wave moves. The AriasWave set of corrective patterns occurs in waves B in brackets of a zigzag and waves 2 and 4 of a 5 wave move. Okay, so very, very straightforward uh, notes or points there, but in practice, obviously, markets take time to produce those patterns. But once they produce them, I mean, you can just use this information to your advantage. So interest rates up, US dollar up, everything else down. In my opinion, that's what's going to happen. Okay, interest rates up, US dollar up, right and right until we hit those highs as mentioned, and then after that, we will probably see a pretty big reversal, a very, very large reversal in the opposite direction for each of the markets, right? So we're in a pivotal moment in the markets, and that's what's driving this whole thing. Basically, it's all come down to these moves now to finish off patterns that started decades ago. And once you get into that, I mean, it just becomes easier to sort of gauge where we are and what to expect next. I don't think we're going to go much higher than that red line. To be honest with you, I think it'll barely nick it. Or it might go a little bit higher, but it'll get really weak by that point, in my opinion, and that's due to obvious, interest rate pattern. The 10-year bond yields going back to 1100 AD. It just paints the picture of the end of a huge correction, and then obviously those will cause the reversals to occur. So, whether you believe in efficient markets or not, I think that's relative, in my opinion. That's a very relative thing to believe in, because whether they are efficient or not, the patterns are efficient and they exist. So I think that's an interesting thought. I've been thinking about that one lately. So that's basically it for now in a nutshell. So, well, pretty big nutshell. Video's gone for 16 minutes. So we'll leave it there and we'll see what happens in the weeks to come. And I'll keep you updated shortly with the crypto market update. So hopefully you found this one interesting and informative.